the organizer of the New York Investing Meetup, and this is an intermeeting update from September 2008. Today we're going to discuss the market crash that took place on Monday, September 29th. Now, traditionally the definition of a market crash is a market drop on an index or one of the indices of 5% or more in one day. Using that definition, it was a crash on today, Monday, September 29th. The Dow was down 778 points. That's the largest point drop in history, not the largest percentage drop, but the largest point drop so far. The S&P 500 was down 106 points, or 8.8%. And NASDAQ was down 199 points, or 9.1% in just one day. Now, NASDAQ is more volatile than the other indices. It tends to go down more, so it's not so unusual it would be down more than the Dow or the S&P. However, there is a ban on short selling of financial stocks. The S&P has a lot of financial stocks, and the Dow actually has a number of financial stocks also. Without that ban, those indices would have gone down substantially more. And both indices may have been down even more than the NASDAQ's 9.1%. Wall Street bailout bill failed in Congress. The vote was fairly close. It was by about 20 votes, but this was meant to be a huge giveaway to support the financial system, and it failed. The market was jittery in the morning. It was going down. Before the market opened, there were 3 major bank failures in the world. When the bailout bill started, there was lots of votes against it. It looked like it was going down. The market went down. And when it became clear it would actually lose, it was the Dow dropped about 300-400 points in 5 minutes, and then started to recover, but by the end of the day actually went back down and lower. Same thing with NASDAQ, same thing with the S&P 500. Now, by the end of the day, it was also quite interesting. NASDAQ dropped approximately 35 points at the very last minute. It was a huge move straight down. And there was so much selling on the Dow, it didn't stop. The index did not settle until about 4:15 instead of the usual 4 o'clock. Because the selling just went on and on and on and on. And what was happening is there's something called the sell-on-close orders, and they get executed at the end of the day in the market, and those orders were massive. Those come from mutual funds, pension funds. These are very big orders, big money. Big money players were desperate to get out of the market. Although the stock market was going down precipitously, crashing, gold actually went up. It closed up over $20 on the day, and was up actually even much more during the day. Now, gold, the ultimate safe haven during market turmoil. If you go back and look at the 1987 crash, which was the worst day ever in the history of the stock markets, you will actually find a number of gold mining stocks actually went up that day when the average stock was being slaughtered. Now, gold tends to go down if the dollar goes up and vice versa, and in the morning the dollar was actually up, and gold was still up. And this was because instead of trading on inflation, gold was trading as a safe haven. And something else to consider, is this the bottom? The answer is no, it's not the bottom. We're not there yet.